Hey, this is Joseph Flannery, founder and CEO of SELFi.com, and this is Lifting the Curtain on Mortgage Lending. All right, I'm going to tell you the way that mortgage rates work. You're not going to hear this from any other mortgage loan officer. No one, no mortgage broker or loan officer breaks down mortgage rates like this to the consumer, because, to be honest with you, it's not very easy to understand. But I'm going to try to explain it as concisely as possible so that you can understand the way that mortgage rates work. So here's the way that mortgage rates work. You have to think of mortgage rates really as if every single interest rate is available. One of the most common questions I get is, hey, what's the interest rate today? Well, to be honest with you, we have every rate available. It could be from 3.25% all the way down to 5.5%. And everything in between. And usually the way that rates work is that they adjust based on the eighth. So then you got 3.375. And then you got 3.5 and 3.625. And then on and on and on, all the way to 5.5. So every interest rate is available. So you might ask, why would someone take a higher interest rate? Okay. Now, if you're deciding between a 3.25 and a 5.5, obviously everyone's going to take a 3.25%. No brainer. But then it becomes a little bit tricky because you have this thing called pricing. So next to each interest rate, there is a corresponding pricing to that rate. And so what I mean by that is the pricing is reflected in the terms of basis points. So let's just say, for example, let's just use a 3.5% rate and a 4.00%. So 3.5, 4.00. Now let's say at the 4% interest rate, the pricing on this is negative 1.00. And the pricing on this is 1.00 positive. Now let's say if the loan amount is $400,000. $400,000. Okay, so you have a $400,000 loan amount, and you're deciding between two options, 3.5, 4%. Now, if all the costs were equal between these two, everyone would choose 3.5. But here's where it becomes a decision. It doesn't necessarily mean one's a bad decision. At the 3.5, you have to pay 1% to get that interest rate. So 400,000 times 1.00 equals $4,000. So that means you have to pay $4,000 in origination fees, plus all the regular fees like the title fee and the government fee, fees that are just going to be there regardless, like the notary fee and things like that. On the other option, the 4%, you get a 1% lender credit. So 400,000 times 1.00 negative equals negative $4,000. So that means you're getting a $4,000 lender credit, a credit to go towards the closing cost that exists on the loan. So instead of the title fee, let's say if the title fees are $1,000, well, now you just used $1,000 of your $4,000 lender credit to go towards the title fees. And so often people ask me, how can there be a no-cost loan? And the truth is that there is no cost loan, but what the lender is selling, what they're saying is that you take an above market interest rate, and let's just add this one in, 3.750%, and the pricing on this is 0.00. So this is called a par rate, meaning you're not paying anything, you're not paying any origination fees to get this rate, but then you're also not getting any lender credit at that rate. So people ask me, how can I get a no-cost loan? Like how, and the answer is they don't exist. The government is never going to waive their fee whenever you do a mortgage transaction. But the way you can do a no-cost loan is you can choose a rate that is above par so that you get a credit to go towards the closing costs. And if the credit that you're getting is more than or enough to cover all the closing costs, then you just did a no-cost loan. That lender credit just paid for all the fees associated with the loan. And there could be negative closing costs. So for example, in this case, the 4%, you're getting a $4,000 lender credit. Well, let's say if the title, insurance, and notary fees and those third-party costs are at $1,000, and let's say the prepaid interest is $500, and we have another video about why there's prepaid interest when you refinance or even when you purchase. And let's say the government recording charge and any other fees is $500. Now you have $2,000 in closing costs. So $2,000 is the closing cost. If you were to choose a 3.5, it would be $6,000 because you have to pay the $4,000 point to buy down to that rate, and then plus the $2,000 in the closing cost, so $6,000. At 3.75, you don't get any credit, but you don't have to pay anything for 3.75, so then the closing cost would just be $2,000. But at the 4%, you get that $4,000 lender credit. So what happens is after you apply that $4,000 lender credit, you have negative closing costs by $2,000. This actually exists, by the way. I actually just did a refinance where the lender paid the client $2,400. They basically gave the client $2,400 to put in their pocket. Now, the $2,000 is applied as a principal reduction after the loan closes. So all the costs are covered, and then that excess credit gets applied as a post-closing principal reduction. And so that's really the way that interest rates work. And so when I talk about pricing, what we're talking about is this. This is the pricing. This is the rate. So someone who isn't as savvy about mortgage rates, they'll say, hey, what's today's rate? What's the rate can I get? Someone who's very savvy about mortgage rates, they'll say, hey, what's the pricing at 3.5? Because then they'll call up a different company and say, hey, what's your pricing at 3.5? What's your pricing at 3.5? And typically the mortgage loan officer is a sales agent. They're going to kind of give you the run around, try to confuse you. But trust me, there is a pricing at every single rate. Every single mortgage company operates their rate sheet like this. And so what SELFi does is we aggregate wholesale lenders. So wholesale lenders give us the best pricing, insane pricing compared to what they offer directly to the consumer. And then SELFi earns 1/3 of the industry average on a conforming loan. And so just by choosing to earn less, we can pass this pricing, that wholesale pricing, to you at a much more affordable cost than what a direct-to-consumer lender or what really any other lender can offer. And so that's kind of our model, is to really pass that wholesale pricing to the consumer. And when we talk about pricing, we're talking about this. So you can get a 3.5 from 100 different mortgage companies, but the price of that 3.5, the cost of that 3.5 is going to vary by every single one of those mortgage companies. And our mission is to offer the best pricing, so the lowest rate at the lowest fees, and try to accomplish that goal in the shortest amount of time.